Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Brian Curtis along with Doug Krisner. Join us each day for the stories making news and moving markets in the Asia Pacific. You can subscribe to the show anywhere you get your podcasts and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
Today, President Biden and Chinese President Xi held a call earlier, their first since a one-on-one back in November. Let's take a closer look now with Bloomberg White House Correspondent Michelle Jamrisko, who joins us from the District of Columbia. Good of you to make time for us. Always a pleasure.
Good to be with you guys.
So at least they're talking, right? I mean, what do we know about what was said in detail?
Yeah, at least they're talking is the key here. I mean, this call was, more than 4 months in the making. It really started where they finished off in November at Woodside in California, talking about the meaning of actually maintaining communications, especially at the leader level. So they had a laundry list of topics. In fact, it was only after we got readouts from both sides, from the U.S. side and from the China side. And of course, those are a little bit different in terms of interpretation of how the meeting went and the priorities. But it was only after all that I, put on a piece of paper, okay, here are the issues they talked about where there are areas of cooperation. Here are the areas where there are tensions. And really the lists are similar in length. I would say the weighty ones are more on the tension side. They talked a lot about tariffs and export controls. The China side thinks that there are so-called endless restrictions on tech sector from the U.S. There were data security concerns. Of course, TikTok came up, as you mentioned, election interference, and then a range of geopolitical issues, South China Sea, support for Russia's defense industrial base that's really concerning on the U.S. side, Taiwan, Hong Kong. I mean, the list goes on. And on the cooperation side, I mean, they're looking to kind of advance some progress out of those meetings in California in the fall, especially on combating fentanyl and drug trafficking there.
Yeah, let's talk a little bit more about that, because I think the state media in China is actually portraying this as a kind of conciliatory stance taken by President Xi, not with a lot of examples of it, but it seems like it's in contrast to what we heard before. And in fact, the People's Daily also called for improved ties. So that's the general thrust. What would if we had, let's say, a softer, gentler Communist Party, what would the U.S. most like to see here?
Well, I think they would most like to see, top of the list in terms of cooperation is that further progress on drug trafficking. They've talked, the U.S. officials have talked about wanting to see more cooperation, further signs that Chinese are cracking down on drug producers and what they call precursor chemicals to fentanyl, which of course is coming in to Mexico and coming over the border. And so that was high on the list in November, and it remains high on the list in terms of trying to find ways of cooperation. I think they're also one burgeoning issue, which is really interesting, is artificial intelligence risks. Now, we saw a resolution out of the UN approved last week that was co-sponsored by many countries, over 100 countries, including China, but was written by the U.S. And it was all about just kind of finding ways to share information around AI. Not so popular a discussion when you're talking at the same time about the U.S. trying to restrict data security issues and finding many reasons to restrict data going into China from the U.S. and trying to protect Americans' data as they see it.
So, Michelle, from what I understand, the White House also hinted at a pending decision on tariffs. I mean, what do we know about this? Are there areas of specificity?
Yeah, that is a tricky one, Doug, because that is something that we have been waiting for on the heels of some other announcements they've made around data security and on Chinese cranes and other issues earlier this year. We have been waiting for those potential revisions to what they call the 301 tariffs, the tariffs that were put in the Trump administration. And the read has been for quite some time that we don't know when it's coming, but that we do expect the Biden administration to maintain those tariffs and maybe even enhance them in some way, and sort of they've signaled that they want to kind of update them for the next generation, to kind of put finer points on certain areas of tariffs that will kind of match the U.S. goal of trying to counter China's tech issues and trying to protect, again, data security for Americans. So we don't know. We know that it came up. The White House spokesman John Kirby today in the briefing was saying the 301 tariffs did come up, but they did not come come up. I'm getting confused with the TikTok issue. But
yeah.
they did talk, the U.S. did talk in broad strokes about the need to kind of keep up some of these tariffs and export controls, which, as I say, was not, of course, popular with President Xi at this time.
You must have been reading my mind, because I wanted to ask you about TikTok. I know that we can't know. We all wish that we could be a fly on the wall in those discussions or on the phone call between the two. I mean, so many things, it's hard for China, in a sense, to agree to what the U.S. wants. I mean, China simply cannot come out and say, okay, we'll go slow on tech development. You know, you wouldn't expect them to say that. It's impossible. And on TikTok, to sell it, it seems like a tall order. I mean, what do you imagine they discussed about TikTok?
Yeah, I think this one is more kind of a reiteration of positions. They talk a lot about, okay, yeah, we know we disagree on things like Taiwan, and we know we disagree on things like TikTok, and we know we disagree on, how much, the U.S. might try to apply export controls, and China from the other side, and both sides are angry at the other on those issues. But they do see value, the Biden administration says, in at least explaining yourself. And we've heard this from National Security Advisor Jake Sullivan, that they should be able to, he talks about having a sustainable China policy is about holding multiple truths at the same time and working to reconcile those truths with the other side. So they see value in sending cabinet officials over to Beijing consistently and explaining what's coming, even if what's coming is then a hit on the nose or in the form of export controls or something else that might restrict China's economic rise in some way.
Yeah, and from President Xi's perspective, in the background, I mean, the fact that President Biden is facing re-election, and I wonder if that was kind of suggested in any way. Joe, I wish you the best, or whatever was said. Michelle, thank you so much. Bloomberg White House correspondent Michelle Jamrisko joining us as we took a close look at the phone call today between Presidents Biden and Xi, their first since November. Let's get to Singapore next, and our guest is Mark Cudmore, Bloomberg MLIV Macro Strategist. His focus is on the foreign exchange, rates markets, and we're going to talk about what we heard today from two Fed officials who happen to be voters on the Monetary Policy Committee, at least for this year, and they are still, my friend, expecting 3 rate cuts in 2024. What is very interesting, Mark, is that the market seems to be expecting fewer rate cuts than the Fed. Why do you think we're getting this disconnect?
Well, I just find both the markets and the Fed just are ridiculous at the moment. There's no way we're going to get 3 rate cuts. The economy is way too strong. There's no justification for any rate cuts at all at the moment. The only way you're going to get rate cuts is if you have a severe deterioration in the U.S. economy. And I'm just not seeing what's going to cause that at the moment. I know that the Fed is desperate to cut, and that's fueling part of the problem. They kind of gave that signal in December. I feel they repeated the 2021 policy error. Jerome Powell made very clear that despite the former rhetoric, he basically wants to be Arthur Burns, not Volcker, and he wants to fuel another inflationary bubble. So that's what we got from the December message. He reiterated that in March, and I know they're inclined to try cutting one. Maybe they'll get away with one before it'll be proven what folly that is. And I'll say something else. Not only do I think it's very unlikely that we get more than 1 rate cut, if we even get one, but I think it's more likely, I know it's to the extreme, that we'd end up getting 150 rather than just 50. And what I mean by that is the only justification for getting more than 1 rate cut, if even one, is because we got a severe decline in the US economy, in which case the Fed will be panicking and cutting rates drastically.
Well, the Fed would possibly be cutting rates, not because of strong economic growth or lack of it, but more because inflation's coming down. And you have to admit, Mark, the PCE numbers that the Fed looks at most closely do have a 2 handle, 2.5 and 2.8%. And with the Fed funds rate at 5.5%, does it not have a little bit of room to move to the downside? Your answer, no. I know, is no. So is that PCE that we're celebrating has come down to the
this level, it's still above target, I think, importantly. But not only that, we know that we're through the disinflationary wave from base effects. So we always knew that inflation was going to come much softer into the first quarter of this year, which is part of the reason why the Fed was hoping to be able to cut rates. We've now kind of reached near the end of that trend. So base effects will start being less supportive for the disinflationary trend. And now we've got oil prices way higher. And we've got a strong economy that seems to be reaccelerating. So no, the answer is most definitely no. I mean, like, this is if we're not at the trough in core PC, we're pretty close to it. And where the trough, member, is still way above target. So this is an economy which is saying, hey, wait a sec, monetary policy is still too loose. So why would you ease it further? You need to tighten it more.
Well, can you help me understand why, or what may explain the Fed's inclination to want to cut? And I'm wondering whether or not it's something underneath the hood here, something in the market where they're trying to stay true to that course as a way of alleviating stress down the road, somewhere in the credit market. Is that possible?
Yeah. So I think there's a few explanations. It's a great question. So I think there's a few explanations. Let's go to the elephant in the room. A lot of people think that there's politics involved in this. I'm not. Maybe not. I don't have enough to speculate. Ignore that. But I think there's two other issues. I think there's one is, were they worried at the economy? And in fairness to them, I think that a lot of the metrics for judging the strength of the US consumer have been completely broken in recent years, not just because of the pandemic distortions, but behaviors changed. And then we always have these buy now, pay later models, which means that the metrics you used to look at would say that the consumer should have fallen off a cliff around the start of this year, end of last year, in which case the Fed should have been worried. But the consumer's clearly not fallen off a cliff and the economy is still very strong. So that's not come through. So I understand why they might have been worried, but they should now change their mind. So I understand why they did the conversation in December, but it's time to now change their mind on that. And the final thing is, are they worried about a credit crisis? Are they worried about commercial real estate? Maybe, but I'm just not seeing that as being systemic. Yeah, sure. It's going to be problematic for certain regions. Certain regional banks will suffer, but there's thousands of banks in the US, and they're far too many. So I think some regional banks can sadly go, and it won't be systemic.
So, Mark, yours is a very bullish view. You're quite bullish on the US economy.
Look, since the December Fed, I think the December Fed was mind-blowing. I did not expect it. I actually wrote a piece that day going, there's no way the Fed will repeat the errors of 2021 by being super dovish while reiterating economic optimism. I said the only reason they could be dovish is because they express concern about the economy. And instead they were like, we think growth's fine, and yet we still want to cut. And therefore,
but briefly then, Mark,
got to be bullish.
You're bullish on the economy, clearly. Are you bullish on stocks here?
I'm not even super bullish on the economy. I'm very bullish stocks globally. I'm always less excited by US stocks, incorrectly so, clearly, because they always keep on outperforming. I just think because they're more expensive. But look, I'm bullish stocks everywhere. I just think there are better opportunities elsewhere. I've said that before and been wrong. But I'm very bullish stocks everywhere since December. I don't think the economy is I think the economy is perfectly fine. But the point is that the economy is saying we can cope with the level of rates at the moment, and therefore earnings aren't going to suffer. The consumer is going to keep spending. The labour market's still strong. Companies are still going to make a lot of money. So yeah, stocks. I'm very bullish stocks from a macro point of view for a good while. Yeah, I just do not see anything on the horizon to change that.
So I was going to ask about strong dollar weekend and possible intervention on the part of the Monetary Authority in Japan, but we're out of time. We'll have to save that for later. Mark, it's always a pleasure. Thanks for making time for us. Mark Cudmore, Bloomberg MLIV Macro Strategist. He focuses on the foreign exchange and the rates markets.
Well, joining us now is Michael Liang, Chief Investment Officer at Foundation Asset Management. So, Michael, we just heard about how strong economic news in the U.S. is causing some concerns that will be higher for longer on rates. Is it such now that good news is bad news?
To a certain extent, yes. Rising interest rates or higher for longer interest rates is a tightening bias for Asian equities. But having said that, given the valuation is so low right now, you have two different driving forces behind it.
When you say two driving forces, what's the other one? I mean, okay, if we can talk about high U.S. interest rates, what's the other driving force?
Valuation. Yeah, for example, MSCI China trading at 8 times earnings for this year, and Japan about 25, India about 27. S&P 500 about 20. So it's really about half of the valuation of the major markets. Yep.
Well, we always have overhangs in markets. Obviously, we're worried now about higher for longer in the West. Here, we've had policy has been one very deep consideration for whether or not you want to buy Chinese and Hong Kong stocks. How do you gauge policy at the moment? And, with valuations where they are you seeing a green light?
Policy impulse is the difficult one to judge. Over my 30 experience, I do not consider front-running policies will be an investment strategy, especially given the longer-term headwinds of Chinese economy, namely, demographics, property deleveraging, and so on and so forth. So that's probably much longer driving force behind. In the short run, I'm sure policy going to come out here and there to support, but it probably going to change trajectory here.
When you look at the deflation story in China, I know we're going to get the official inflation reports next week. Is this something that's going to be persistent, do you think? Is China going to be dealing with maybe what Japan dealt with for a very long time, beginning with the late 1980s?
Well, if I have a crystal ball, I would say yes to that question. You would have volatility in CPIs in China, but the trajectory is, demand is slowing, people are aging, property is more abundant, in supply. I don't think there is a rush, people pay up prices because they think price going to go up in future, right? But given the situation we're in today, there's just no rush to buy everything today.
This is very interesting because you started off as saying that low valuations were a consideration. And yet when we mentioned one challenge, possible challenge policy, you said, hey, there are even bigger challenges. The demographics is one and the property crisis is another. So how do you actually sit on the line between bullish and bearish? Are you bullish or are you not?
Well, that's a very good question, Brian. At Foundation, we more of long-short equity per se. There's always positives and negatives, especially given the headwinds we have in China. Actually, stronger companies, when we look at them, actually they're holding up okay. But in this challenging environment, you have many companies, the weaker peers actually suffering a lot. So yes, it's not outright bullish or bearish. It's more of where you see from a bottom-up point of view, where you see the values and versus a company probably not going to do.
You were talking a moment about volatility, and I'm wondering whether you're tempted to abandon your role as investor and take on the role of trader and exploit that volatility and maybe make short-term trades rather than investing for the long term. Is that a viable strategy for China?
Maybe it's a viable strategy for the others, but not for us. We are bottom-up fundamental guys. Our horizon is in numbers of years rather than number of days. For example, take a look at the EV, right? Yesterday Xiaomi's pre-order was very, very strong. Stock went up, but at the same time, I don't want to name names, but the usual suspects, some shares actually went down yesterday in the EV space. So the general forecast for global EV demand is about 20 million globally this year. 17 million this year. But China alone, the production capacity is 20 million. Okay, there's a massive oversupply on the horizon. In the end, as an equity investor, you prefer a business not only can sell well and also can sell well at a good price, good margins. And in this environment, even in EV, not everybody gonna be happy at the end of the day.
So, Doug, Michael is very interesting because to my question, are you bullish or bearish? You know what his answer was? Yes.
I'm both.
Yeah, because he's really looking through the markets. And I find this other line here from one of your themes to be kind of intriguing. You like PCs over smartphones. Wow, lay that out for us.
All right. Again, it's probably come from the competition. A PC is not rocket science. During the COVID, globally people work from home. a lot of PCs being bought during that time. But having said that, for the last 2 years, it went through a slump. It's a very cyclical business. Now we come out this PC cycle, replacement is coming in again or happening again. For the next 1 or 2 years, not only AI-driven PCs, but just general PC replacement is coming in. And for the smartphone, it's very difficult because there are so many smartphone makers.
Yeah.
And for AI-powered smartphones, we're a little further out.
Well, that's interesting that you bring up artificial intelligence, because we were talking a moment ago about this phone call that took place between Presidents Biden and Xi earlier. And I think from the China side, just a little bit of criticism at the restrictions that the Biden administration has placed on access to some of this most sophisticated high technology equipment. Do you have confidence in China's ability, given the world that we're living in right now, to kind of cultivate its own high technology, I want to use the term sector, I don't even know that that's right. Semiconductors clearly are going to be an issue, and where AI is concerned. Do you have confidence in China's ability to maybe cultivate a homegrown semiconductor industry?
I have confidence for China to do well in the traditional legacy nodes, the lower tech semiconductors. The leading edge semiconductors, given the restriction sanctions in place, that progress is being slowed. Eventually, China might achieve that, but, maybe 2x of the time.
Okay,
3x.
you were going strong there on PC makers, replacement cycle and all. Any that you favor?
Well, there are only 3 major PC makers in the world, right? Lenovo, Dell, and HP.
Yeah.
Take your pick.
Take your pick.
Well, I think I'll take the first 2.
Yeah, great. So you're long and short. So I want to know who you're going short. We'll say that for the next time. Yeah. All right. Thanks very much, Michael. Pleasure. A real interesting discussion. Michael Liang, Chief Investment Officer at Foundation Asset Management.
This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.